So hello and welcome to our YouTube channel everyone, and from today we are going to start a derivative series for all of you. In this series we are going to explain you everything that you need to know about the derivatives, how to trade in the derivatives, what are the different terms that we hear about the options and the futures and what does they mean, because many of you might be trading in the derivatives, might have heard about the derivatives, or might be someone is completely unknown with the derivatives. And the purpose of this series is to educate you about the derivatives. What are derivatives? Because knowing the essence, the basics of something is very important before we start, before we begin, before we take trades. Because it happens, it is found very normally that the people do trade based upon somebody else's advice and get stuck into any particular trade on derivatives, and derivatives are risky instrument that they can wipe out your capital. That's why being aware about the derivatives is the very important part. That's why we have brought this series for all of you. In this series we are going to cover each and every aspect of the derivatives. We are going to teach you the theoretical terms, those are related to the derivatives. So if any point of time in life you come across that, you should know what does it means. Plus we are going to show you some good things on the charts which are going to be useful for every one of you. So let's start the derivative series. Let me show you something. Now this is the option chain data given by the NSE. This data is available for all the NSE indices whose derivatives are in trade, like Nifty and Bank Nifty, plus any stock whose options and future derivatives are available. That data is also given by the NSE. And we often heard about different terms like strike price, what is the current price, and what is the open interest in any particular option. And what happens that we are completely unaware of that, so we don't understand, we just take trades based on somebody else's advice, and we can get stuck up at any point of time, and that can cause us severe losses. So what we are going to do is we are going to educate you about all these things. So any time now if you take any trade based upon somebody else's advice also, then also you are also aware of the thing, then you can recheck, you can reconfirm that whether this call is right to enter or not. So that is the purpose. So let's begin with our derivative module. So what are derivatives? Derivative is financial contract which derives its value from an underlying asset, reference rate or index. As we have talked about it, derivatives are financial contract. They derive their value from an underlying asset. Look, if we go here on the charts, we can see different assets. Suppose there might be some commodity that is in the trading. We are trading on a commodity, so that commodity as a particular, look here, MCX Buildex futures, as we can see. So this is an asset, the commodity is an asset, right? Derivative derives their value from these kind of assets. It can be commodity, asset like commodity, it can be any reference rate. Suppose what is the market rate given by the banks, or what is the rate at which banks borrow from each other, as we have taught you about the repo rate in the past videos, or index like Bank Nifty and Nifty. So they derive their value from these things, generally from these things. It is not a very subjective matter, it is an objective matter in which there are certain different things which are defined and derivatives derive their values from. But at the same time, if somebody wants to create an asset or create a thing on which they want to derive derivatives, you can do that. If you are deriving financial contract on anything, based upon anything, that will be called as derivative. Derivative are generated through spot markets, as a spot market is something where the assets, underlying assets, interest rate or stocks or indexes are traded, and they derive their value from those spot markets. They trade in the derivative market. So it is a different form of market altogether. There is an, if we take example of the NSE, let's talk about the NSE index is Nifty 50. So Nifty 50 is trading in the spot market, and derivative, the option chains or the futures which on the Nifty will derive their value from the spot market to the derivative market, and they will trade in the derivative market. So why does this happen? Because there is no way that you can buy Nifty 50. If you are thinking that this can go up, Nifty will rise, I am bullish about the Nifty and I want to gain, how can you gain? You can't buy Nifty 50. Or there are two options available to you. The first option is buy all the 50 stocks Nifty 50 comprises of, or you simply go buy the futures of the Nifty 50 or take a call option on the Nifty 50. So buying those 50 stocks which are included in the Nifty 50 is not feasible. It's not practical for everyone. Some big institutional investors definitely can do that. Some high net individuals can definitely do that. For a common man like us, a retail investor or even a professional trader, it is not possible to take a stake in all the 50 stocks. Those are included in the Nifty 50. So what we do, we buy the futures of the Nifty 50 or we buy and call option on the Nifty 50. Similarly, if we want to go short, we feel that market is bearish, what we should do? Then you can't short sell all the 50 stocks of the Nifty 50. Short selling all the 50 stocks of Nifty 50 is nearly impossible for everyone. I'm not talking about just you and me, but for the institutional investor also, it is very difficult to short sell the 50 stocks. So they also short sell the futures. They sell the futures or they buy a put option on the Nifty. See, so this is how things take place. Now, what was the purpose that derivatives were derived? Everything was going fine. Spot markets were there, commodities were trading there, indexes were there for giving us a forecast view that what is going to happen in the market. Then what was the need to come and create the derivatives? So derivatives help in risk management, transfer risk from hedgers to speculators. Now, who is a hedger and how he transfers his risk to a speculator? Suppose I am a farmer. I farm rices. Rice is what I do farming about. So the thing is that I want to sell my rice after 3 months. So what should I do now? The prices in the market are 50 rupees per kg as of now. But what I am thinking is that the prices will fall. This is what I am thinking, or might be I am afraid that prices might fall. If I'm not an analyst, if I can't forecast what is going to happen in the market next, then simple thing what I can be is that I can be afraid of the prices falling. So what should I do now? I will go to any person and will tell him, do you want to buy my rice? That person will say, at how much will you sell me your rice? The farmer will say, I'll sell my rice to you at 50 rupees per kg. Now, the person who is buying those rice is a speculator. What he is thinking? He is thinking that the prices of the rice will rise. It will go further above the 50 rupees. So what will happen? The farmer will sell his rice to him at the 50 rupee and will hedge himself. And the speculator is expecting the prices to rise. That's why he will buy the rice as 50 today for a delivery after 3 months. So this is how risk management happens. The hedger get hedged and the speculator got the speculation entry. So this is the first purpose of the derivatives. Why was derivatives derived? Used in hedging, speculation and arbitraging. Hedging and speculation, I have told you, and arbitraging is a process in which there is no capital involved, there is no risk involved, and there is just a short profit booking happens. So these are the three major things for which derivatives were derived. Derivatives, the third point is make short selling easy. As we have talked about, derivatives make short selling easy, because if you want to short sell any stock, any commodity in the India, I'm not talking about the intraday purpose, I'm talking about if I want to short sell a particular stock or an index or a commodity or any interest rate for a month or two, I just can't go and short sell that. For short selling in India, we have to take permission from the SEBI, and then our broker approves that, then only we can short sell, and that too not for that longer period. This kind of longer period short selling is not easily available to big institutional investors as well to the big high net individual. The short selling is not easily available for them also, so how it could be available for us? So that was the problem. That's why the derivatives were derived. If I am thinking that the gold prices are going to fall, I can easily short sell the futures of the gold. Or if I'm thinking that any other commodities prices are going to fall, I can short sell. If I'm thinking the Nifty is going to fall down, I'm going to sell the futures of the Nifty or buying a put option, or I can write a call option. So there are different options available through which we can short sell any asset, any index rate, or any interest rate, any index or any stock easily. So it makes short selling easy. Liquidity, now the liquidity derivatives increases the liquidity in the market, as the stocks are heavily priced, they have high values. That's why we can't buy the stocks so easily. If I'm going to buy the stock for Reliance, then it priced near 2000 rupees, so it is very expensive, and I can easily buy the options on the Reliance which are much less expensive than the original stock of the Reliance. So this is how derivatives also helps in providing the liquidity. Now, lower transaction cost, because whenever I take entry into the stocks or into the commodity, the transaction, the amount in which we do transaction or we have to pay so heavy, the taxes on it and the transaction cost is much bigger than what we have to pay for the derivative trading. It increases efficiency, as through derivatives people can short sell and people can also go long for the heavy amounts or for the heavy quantity. Whatever the news is are coming out in the market gets directly reflected in the prices. If somebody comes to know that the market Reliance prices are going to fall because their annual reports are not good, we can easily go and we can easily short sell the Reliance, or we can buy the option, call option, or we can buy the future if we feel the prices are going to rise if any news are coming out of it. That's how derivatives also helps in the increasing efficiency. So these are the some uses of the derivatives, and the data of the data on the derivatives is always available on the NSE option chain, and as well as on the charts. Wherever you are seeing that different brokers, they have their own charts, they provide the information about the derivatives on that, or you can use any software websites like tradingview.com as I am using right now. So these were the some purposes of the derivatives. I hope you have understood what are the derivatives and what are their purposes. In next session we are going to look further into this matter and gonna make a broader and clearer view about the derivative. So I hope all of you have liked the video. Please do comment and tell us how was this, and don't forget to like, subscribe and share our channel. Thank you so much everyone for watching this video.